Today is the third webinar in the series on tax considerations. And the purpose of this webinar is to give you some general income tax considerations. And of course, as always, you should consult with your accountant on specific information related to your business. But we have with us from Grant Thornton Accountants, Randy Momot, who is a partner with Grant Thornton and who you might recognize as GGO's accountant for a number of years. And joining Randy is Jamie Vongpit, manager, and Jack Kingma, senior manager, tax services with Grant Thornton in St. Catharines. I'll turn it over to you, Randy.
Yeah, thanks, Mary Jane. Hi, I'm Randy. We've really been proud to kind of serve the marketing boards and the grape growers in particular for over 30 years. Jack Kingma is a colleague of ours, the senior manager in taxation, and we devotes a lot of his time to working with growers in taxation matters, and particularly lately with the demographics of the growers community. There's a lot of need to advise on transition of the farm, of the vineyards and assets such as that. So Jack's got a lot of experience with that, and he's got a presentation on some what we think are some relevant and current matters anyway. So I'm going to turn it over to Jack now.
Thanks, Randy. Thanks for the introduction, and I want to thank everyone for the opportunity to present here today. So today I'm going to be going through tax considerations for transition planning, mostly focused on farming context, as most in the grape growing industry are farming businesses. And we'll be going through a number of different topics related to that. Yeah, so some of the topics we're going to cover today are capital gains deduction and use of the capital gains deduction within the context of transferring qualified farm property. So every individual has a lifetime capital gains exemption available to them of $1 million each. Then we'll look at the transfer of other farming assets. So particularly just the tax implications of transfer of farm equipment like machinery and inventory. Then we'll get into and look at the specific rules around intergenerational transfers of qualified farm property that allow for a transfer from a parent to a child or grandchild at any amount between the fair market value of that property and the cost of that property. Then we'll also look at changes to transition planning strategies resulting from Bill C-208, which was a private member's bill that was introduced in June 2021. That has now allowed for more complex strategies to facilitate the tax efficient transfer of ownership between generations. And then finally, I will touch on briefly life insurance and how it can be useful in equalization of inheritance and also in funding of estate tax liabilities. So first, we're going to kind of look at the capital gains deduction in the farming context, the $1 million capital gains exemption that is available to each individual, and how it can be used to increase the cost of a property on a successive transfer to the next generation. So I'm going to start by going over some key definitions relating to the lifetime capital gains exemption. So within the farming context, there's actually two definitions of qualified farm property. And qualified farm property is criteria have to be met to meet the definition of qualified farm property in order for a transfer of a property to be eligible for the capital gains exemption to be claimed on any capital gain on a transfer of that property. So there's kind of two definitions here of qualified farm property. There's criteria that apply to properties acquired before June 17th, 1987, and to properties acquired after that date in 1987. So if a property has been acquired by an individual before June 17th, 1987, then it has to be used for at least 5 years during which the property is owned by a qualifying owner. It has to be used more than 50% in a farming business in Canada by that qualifying owner. Or in the year of disposition, the property has to be used 50% or more in a farming business. One important thing to note here is that if a property is acquired before June 17th, 1987, and there's a 1994 election made, it will disqualify the property from being considered in the pre-1987 rules. So to give a bit of context around that 1994 election, so there used to be a $100,000 capital gains exemption available to everyone on a variety of property, not just farming property. And that was phased out in 1994, but the government allowed at that time for people to elect to use up that exemption before it became unavailable. So if a particular property, if election was done, it would disqualify it from the pre-1987 rules. And then there's the post-1987 rules, so they're a little more restrictive. Property under the post-1987 rules that was acquired after June 17th, 1987 has to be owned continuously for a period of 24 months before the time of disposition in order to qualify for use of the capital gains exemption. It has to be owned by either the individual or individuals related to that individual. So it could be a spouse or a child as well, included in that ownership holding test. So during that during ownership of the post 1987 property, at least 2 years during ownership, gross revenues from farming must be greater than any other sources of income. And the property has to be used more than 50% in a farming business where the qualified user was actively engaged, or for a period of 24 months, the property must be used in a farming business in which the individual is actively engaged, but the farming business can be carried on by a family farm corporation or a family farm partnership. So to give a little further context around these rules, the change in 1987 was made because the criteria was pretty broad, such that hobby farmers could claim the exemption when they would just do farming part-time. So the post 1987 rules really kind of narrowed the scope of who can claim the lifetime capital gains exemption, such that if you're not a full-time farmer, then you won't qualify. So just one further definition that I wanted to look at in connection with this is the definition of a qualified family farm or fishing corporation. This definition is important because the lifetime capital gains exemption can be claimed on transfer of shares of a qualified family farm or fishing corporation as well. So what a FFFC is it's a corporation that is privately owned and controlled by Canadian individuals. And during the 24 months before the time of a disposition of shares of a FFFC, 50% of the fair market value of the assets owned by that corporation need to be used more than 50% of the time in carrying on a farming business. And then at the actual time of the disposition, more than 90% or more of the fair market value of the assets owned by this corporation need to be used in farming. So an example of non-active assets would be like excess cash. If the company has a lot of cash that it's not using in farming activities, that would be a non-qualifying asset. Another example could be if there's a property that's used for farming, but maybe there's a residential house on that property and that house is rented out to a third party not related to the farming activity at all, that would be a non-qualifying asset. So these things are looked at because if there's too many non-active farming assets in the corporation, then it would prevent the use of the capital gains exemption, and then I'll get into further. Also, it can affect the intergenerational rollover rules as well. So looking at the capital gains deduction in a succession plan on a transfer of farm property, so it can be utilized in a transfer of farmland to the next generation. So the use of the capital gains works best, the capital gains exemption works best in a case where you're transferring farmland that's been used in like a sole proprietorship, so an unincorporated farming business. Basically the exiting owner, so like the parent, would report a capital gain in either the year of the transfer or if they will it to their child in the year of death. And some things to note are, in order for it to be a legitimate transfer, there has to be consideration given for that property in order to have a valid increase to use the exemption. So for instance, if you have a parent with farmland with $1 million cost and they want to transfer it to their child and use their exemption to now bump up the cost of that property to $2 million, they would have to have a legal debt owing between child and parent of $2 million. Some other things to consider on a transfer are land transfer tax. There are exemptions available for farmland, particularly like if the child is planning to carry on farming that property that they're receiving from the parent, then it's exempt from land transfer tax. Another consideration here is alternative minimum tax. So in a year where a taxpayer disposes of an asset and realizes tax sheltered income, so in the case of transferring a farm property, you know, if the taxpayer is realizing $1 million gain and they're claiming their exemption to shelter that gain from tax, the government through its legislation, there's something called alternative minimum tax that kicks in, and basically the taxpayer has to pay this alternative minimum tax up front in the year of disposition, but then it is recoverable in the next 7 years. And the amount, whether or not all of it's recoverable, it's all dependent on the individual's income levels in the next 7 years. So, and then generally using the capital gains deduction to increase the cost of shares of a family farm and fishing corporation it was not very practical prior to the changes that were introduced through Bill C-208 in June 2021. And that was simply because increasing the cost of shares of a farming corporation will almost never get sold, that cost can be used to reduce tax. Like if land or farming assets are ever sold that are owned by a corporation, it's just going to sell the assets. Like the purchaser's not interested in usually buying shares of a farming corporation. So it's somewhat limited in that context before the changes that were introduced by Bill C-208. Next, I'm going to briefly look at the tax implications of transferring farm equipment and inventory between generations. So first, a look at the transfer of farm equipment. So farm equipment transfer from a parent to a child or grandchild will occur at fair market value, and it may trigger income tax. It is not eligible for the lifetime capital gains exemption that can be claimed on transfer of qualifying farm property. And that's because it doesn't meet the definition of qualified farm property, because in the definition, it states that it has to be a movable or real property, and equipment it's movable property and it's not real property. There are some specific exemptions for other types of farming assets in the definition of qualified farm property, such as like production quota. There's a specific mention in there that is qualified farm property, but that is not the case with farming equipment. So generally, equipment does not increase significantly in value, so that there may not be tax implications on a transfer of equipment from a parent to a child. If the fair market value of that equipment is equal to the undepreciated tax costs, then generally there would not be tax implications. And something to note here is that whether that transfer is done upon death or while living, the tax implications are the same. So some further things to note is that if the fair market value of the equipment is higher than the undepreciated tax cost, it could result in recapture income and possibly in a capital gain on that equipment. And then further to that point is there is possible tax planning to do if that is the situation, that the farm could be incorporated, and that would allow for more tax efficient transfer of the farming assets to the next generation. And then any tax planning involving a corporation would have to be done prior to death. If a taxpayer passed away and they own farming equipment with fair market value in excess of its costs, then there would be tax implications at that point. So next we'll look at the transfer of farming inventory. So farming inventory also is not eligible for the lifetime capital gains exemption. Same reason as with machinery. It's movable property, so it does not qualify. As such, a transfer of farm inventory from a parent to a child would occur at fair market value. Generally, there will not be any immediate tax implications as long as the consideration received for the farming inventory is not cash. So this applies in situations where a farmer is operating on the cash method of accounting. And there may be opportunity upon death to transfer farm inventory to a child without triggering immediate tax either. So upon death of a farmer, if they're operating under the cash method, farm inventory can be transferred on a tax-deferred basis to a child or their grandchild, and that inventory will be taxed when it's ultimately sold. So if it's left to a child or grandchild, they will receive the inventory, and then when they ultimately sell that inventory for cash, that's when tax will be paid. So next we'll look at the intergenerational transfer rules, specifically for farming, that are included in tax legislation. And these rules, they allow for the avoidance of the application of income tax on a transfer of qualifying farm property to the next generation. So some key concepts here on intergenerational rollover rules is the transfer needs to be a qualifying transfer. So in order for it to qualify, it has to be a transfer between a parent and a child or grandchild only. And the property itself has to be a qualifying property. And what that means for purposes of the intergenerational rollover rules is that property needs to have been used principally in farming for more than 50% of the years that property's been owned, and then more than 50% of the actual farming acres have to be used in farming as well. So there's some nuances with these rollover rules, because if you get into situations where, you know, a property's been owned for example, for 20 years, and it was farmed for say 9 years, but now that particular piece of property is just rented out to a third party, and that third party's farming it, then for the years that it's been rented out, it's no longer used in an actual farming business by the taxpayer. So in that case, if it was farmed for 9 years and it was rented out for 11, that property will no longer qualify for the intergenerational transfer, and there would be tax triggered on death of the taxpayer or on a transfer by the taxpayer to the next generation. So some other things to note is that the intergenerational rollover rules do apply on a transfer while living, and they also apply on a transfer on death if a property is willed to a child or grandchild. And the rules allow for the property to transfer to any amount between the cost to the parent and the fair market value at the time of the transfer. So that allowance to elect at any amount between cost and fair market value allows for parents to use their lifetime capital gains exemption on qualifying properties as well. Because if a property is worth $5 million and it has a cost of $1 million, then the parent can elect at $2 million to use up their lifetime capital gains exemption to increase the cost of the property without triggering tax on the remaining $3 million of value that is there. So now I'm just going to go through a few examples to kind of illustrate this, these types of transfers. So the first example here is an example where dad is operating a farm as a sole proprietorship, and he owns farmland used in the farming business. He wishes to retire and transfer the farmland to his son. His son is active in the farming business as an employee and wishes to purchase the farmland from dad. The farmland has a cost of $1 million. So in this case, dad would sell land to son for $2 million. He would realize a capital gain of $1 million, which he can use his lifetime capital gains exemption to shelter that gain from tax. Son will issue a legal debt to dad with repayment terms, so that it is a legal transfer and so that the gain is actually triggered. And then dad reports that gain. He can claim his lifetime capital gains exemption. And then since he's receiving debt from the son, to the extent that that debt is not fully repaid at the time of transfer, he could potentially claim a reserve for 5 years to bring that capital gain into income over 5 years. And the advantage of potentially using that reserve is that it could reduce the impact of the alternative minimum tax that is charged by the government in the year of disposition. So there is some nuances to consider there. Other things that need to be considered are old age security and whether or not that would be clawed back. If there's going to be a clawback of old age security, that their dad is receiving that because he's over 65, then you may not want to use the reserve, because then you would be paying a clawback of old age for 5 years instead of 1. And then dad updates his will. That's the last step. such that the promissory notes owing from son will be forgiven on death. So there's specific provisions in the income tax legislation that allow for an estate to forgive a debt on death with no tax consequences. So it's important to note that dad cannot forgive that debt while alive, or there may be tax implications to son, as there's some rules that kick in for debt forgiveness. So then here's another example of just a transfer of a incorporated farm from a dad to a son. So in this situation, the farm co is a family farm and fishing corporation. It meets those two tests that I went through, the 50% and the 90% active business asset tests. Dad wishes to retire and transfer farm co to son. Son is active in the business, wishes to purchase it, and the value per a formal valuation of farm co is $8 million. So one strategy that can be used here to transfer the future growth of the business to the son is to have dad exchange his common shares of FarmCo for shares equal to the fair market value at the time of the transaction, which according to the facts here and the valuation report is 8 million. So you'd have dad exchange his common shares for preference shares, which have a fixed value of 8 million, and then son would subscribe for new common shares. So any future appreciation in the value of the FarmCo as it continues to make income, or as the value of like underlying assets such as land continue to appreciate in value, that growth would go to son. And then dad would slowly just redeem shares into the future to use up his lower income tax brackets and to provide him with cash to live off of. And then assuming as long as FarmCo remains a family farm and fishing corporation, then on death, dad can will his remaining preference shares to son, and through the rollover rules, those shares would transfer to son at cost, and there would be no tax on death of father. He could elect on leaving those shares, those preference shares, to his son, to elect to transfer them under the rollover rules to use his lifetime capital gains exemption, and elect to transfer them at $1 million. And the disadvantage here before Bill C-208 was introduced was that, yeah, that increase in cost of the shares will never really be utilized to reduce tax in the future, because likely those shares will never be sold. And if there is a sale, it will be the sale of the underlying assets of the corporation, in which case, to get money into the hands of son, it would be a dividend income out of the corp, and the cost base cannot be used in that situation. So now we're going to talk about Bill C-208 and the changes that were made as a result of that. So the purpose of Bill C-208, it was introduced as a private member's bill by Larry McGuire, an MP in Manitoba. And basically they identified that there's a huge tax disparity between transferring a business to the next generation, keeping it in the family, versus selling it to a stranger, like an unrelated individual. So if shares of a corporation are sold to an unrelated individual, a capital gains realized, and a capital gains exemption can be claimed, versus if you were to try to sell the shares to your child in the same manner. There's some punitive sections in the Income Tax Act, specifically Section 84.1 and Section 55, that basically result in negative tax implications compared to a sale to a stranger. So particularly 84.1 would recharacterize the capital gain on sale as to be dividend income, which is taxed at a much higher rate. And Section 55 had some rules that would overlook siblings as being related for tax purposes, that also create a lot of complexities in dividing up a family business. So that was all changed when they introduced Bill C-208. So just a couple things to note here on this slide as well. The top tax rate for dividends is in Ontario is around 47%, and more than 50% of businesses are kept, like farms and fishing corporations, are transferred to family members, so they're kept in the family. So why Bill C-208 is important. So changes to section 84.1 now allow a business owner to sell or transfer shares in a small business or family farm and fishing corporation to another corporation, a holding company, owned by the taxpayer's child or grandchild without adverse tax consequences that previously applied. So this piece of legislation did reach royal assent on June 29th, 2021. And then the Department of Finance did indicate that they plan to amend the legislation and that those amendments are coming. Originally, they said either November 1st, 2021 or the date of publication of the final draft legislation. So at this point, we're waiting for the date of publication of the final draft legislation because they have not indicated anything to date as to the amendments that they want to make. So we're still kind of waiting to see what the Department of Finance will do on that front. So just looking at the previous rules, so 84.1 under the previous rules would apply in a situation where you have a taxpayer resident in Canada, which is not a corporation, so it's usually an individual, can be a trust as well. That taxpayer disposes of shares that are capital property to, disposes of shares that are capital property to the taxpayer, called the subject shares. And shares are the shares disposed of are capital stock of a corporation resident in Canada, referred to as a subject corporation. And those shares are acquired by another corporation referred to as the purchaser corporation, and that purchaser corporation and the taxpayer do not deal at arm's length. So that would be in a situation where like a child or grandchild owns the purchaser corporation. And the purchaser corporation and subject corporation are connected for purposes of the Income Tax Act. So to kind of illustrate this, we can see here, so under these previous rules, Mom Co. owns Family Farm and Fishing Corporation worth $1 million. And she's going to sell to a stranger. So that stranger incorporates Purchase Co. and Purchase Co. buys the shares from Mom. Mom gets proceeds of $1 million. She realizes the capital gain of $1 million, and the net tax effect is probably about $23,000 due to alternative minimum tax. Then in option B, it's the same transaction. The only difference is that she's selling it to her son instead of a stranger, in which case Mom receives $1 million from Purchase Co. But under the previous rules, that $1 million capital gain realized on that sale is recharacterized as a deemed dividend, and that would result in around $477,000 of tax owing. So you can see there's a big disparity here as far as the tax result of keeping the business in the family versus selling to a stranger. So what for qualifying treatment under Bill C-208? So Bill C-208 attempts to exempt certain intergenerational transfers from these punitive rules under 84.1 of the Income Tax Act. So some of the criteria in order to fall into this new legislation and be eligible to use your capital gains exemption on a transfer to the next generation where there's a corporation involved include the corporation must be a family farm or fishing corporation or a qualified small business corporation. That other definition, qualified small business corporation, it's essentially the same test. The only difference is it's a corporation that's not involved in farming. The lifetime capital gains exemption is slightly less than the farming exemption, so it's $1 million per person for farming, but it's around $912,000 for individuals for QSBC. And then the purchaser corporation has to be controlled by the vendor's children or grandchildren. Those individuals, the children or grandchildren, have to be at least 18 years of age. And then the purchaser corporation that buys the shares has to hold those shares for a period of at least 60 months and cannot dispose of them for any reason other than death. So Bill C-208 includes a provision also that does grind down the amount of lifetime capital gains exemption that can be used on this type of transfer based on something called the taxable capital of the corporation that is being sold. So taxable capital is essentially the capital that is employed in the business by the corporation. It's a specific calculation, so it's usually the tax paid retained earnings of the company plus any debts that are utilized in the business. So when that number approaches 10 million, then it begins to grind down the amount of capital gains exemption that can be used. And once that number has exceeded 15 million, then you're no longer able to use any capital gains exemption on an intergenerational transfer. And that's just to do with the government wants to make sure that this is for small businesses, essentially. And then finally, in order to qualify under Bill C-208, there does need to be an independent assessment of the value of the shares that are being disposed of, and an affidavit signed by the taxpayer and a third party attesting to the value of the shares being disposed. There's not a lot of guidance currently on what an independent assessment is. We have not received any further communication on that from the government. At this point, it's understood in the industry and wide community in public accounting that if a chartered business valuator values the business, that for sure is an independent assessment. So whether or not anything less would be considered an independent assessment is still unknown, and we're hoping to receive some further communication from the government on this at some point, and likely when they amend the legislation. So now we're just going to kind of walk through an example of a transfer under Bill C-208. So in this situation, you've got an operating company that's a qualified farm and fishing corporation. It meets the tests. Its taxable capital is less than 10 million. Dad owns OpCo and son is involved in OpCo and wishes to purchase it. And the value is $8 million of OpCo per a third-party valuation. So in this case, to transfer it, son would incorporate another corporation, in this case called Sunco, and would purchase the shares from Dad. Dad would claim his lifetime's capital gains exemption on those shares, and then any capital gain over and above the $1 million that can be sheltered would be taxed as a capital gain. So factors here that are important based on the Bill C-208 legislation is that son does control Sunco and son is 18 years of age or older. It is a sale from a parent to a child or grandchild. There is no grind on the capital gains exemption that can be claimed by Dad because we mentioned that the taxable capital of OpCo is less than $10 million. There is a third-party valuation in place to determine the value of the shares of OpCo, and it's a genuine intergenerational transfer. So son is going to be taking over the business from Dad. So under the old rules, this would have resulted in a deemed dividend to Dad for almost $8 million and would have been subject to tax at just over 47%, which would have resulted in around 3.8 million of tax owing. Under the new rules, under Bill C-208, this will result in a capital gain of $8 million to Dad. Dad can claim his exemption on 1 million of that gain. So now there's a gain of around $7 million, and that tax at a capital gains rate is 1.6 million. So you can see that the difference here is a savings in tax of about $2.2 million. So just to kind of highlight some of the risks around the Bill C-208 legislation. So the intention of the legislation is that the federal government is committed to facilitating genuine intergenerational transfers while preventing tax avoidance that undermines the equity of the Canadian tax system. So currently, under the way that the legislation is currently worded, it's quite broad, and it would actually allow for an artificial tax plan where you could do a transfer to children that have no intention of taking over the business. And it would meet the definitions and criteria within the legislation. However, that's not advisable because there's also income tax legislation called the General Anti-Avoidance Rules, and the government, it's not within the spirit of the act or intention of the legislation to be able to transfer a business to a child that is not going to actually be taking over that business. So those are some of the risks there. Like basically, it has to be a genuine intergenerational transfer of that business in order to qualify. So, and then as previously mentioned, the Department of Finance has indicated they are going to amend this legislation at some point. And so we could see further restrictions and criteria in order to meet basically the qualifications to do this type of transfer. Things that we suspect that could be introduced is there could be some limit placed on parent after the transfer as far as the number of hours they work in the business, or there could be some additional criteria that, maybe the children at the time of this transfer, after the transfer is complete, that they have to own all the growth in the company, like all the common shares. There may be further changes that restrict voting control. Like right now, we can do transfers where, if dad still wants to control the company, but he would like to transfer the business to the child, he can retain shares that have voting control and just will those to the child later. Whereas changes may restrict that at the time that this transfer is done, that voting control also has to be given up for the parents. So in Quebec legislation, they do actually have some additional requirements already based around activity of the parent in the business going forward, and other ownership requirements. So just some key points coming out of all of this is brand new legislation. It's likely to become more restrictive, and it is a great opportunity where a child will be a successor of the business, as it gives the ability to access the capital gains exemption instead of utilizing a redemption strategy, which would result in dividend income, which is taxed at a much higher rate. And then other considerations is the timing of the transfer. Like, you have to look at the assets in the company to make sure that it is meeting that 90 and 50% test, to make sure there's not too many non-active assets in there. Other considerations is family needs, like looking at, like in the farming context, if you do this type of transfer, it's often saving the next generation tax, because it allows the next generation to, like, if that the loan created on the transfer is willed to the next generation, it's going to allow the next generation to pull money out of the corporation tax-free on the personal side. Like, they won't have to pay any personal tax. And it's a bit different in a farming context because there is no tax liability on the farm corporation when the parent passes away. Like, as long as it's a family farm and fishing corporation, those shares will just transfer to the child under the intergenerational rollover rules, and there's no tax result. So it's a bit of a different situation than for a business that's not a farm, where there is truly a big tax liability when the parent passes away, when they still own value in the corp. So this just kind of summarizes a lot of situations where Bill C-208 should be considered. So anyone who's transitioning a business from a parent to a child or grandchild should consider Bill C-208. Shareholders that maybe have used part of their exemption but still have some of their lifetime capital gains exemption available should also consider it. Situations where there is a sole proprietor or a mom-dad partnership and they have a child successor, there may be an opportunity to incorporate that business, and then once it's incorporated, have the parents sell the shares of that incorporated business to the next generation and utilize Bill C-208. And finally, also for shareholders who have already kind of implemented what we call wasting freeze, which is basically where you have a corporation and parents have already locked in their value and the kids already now own common shares, there may still be an opportunity to utilize this type of planning and have parents sell some of their preferred shares to a corporation owned by their child to utilize their exemptions. So, and this just again kind of summarizes some of the considerations for Bill C-208. So again, like, purification is a big one, and timing of the sale, and just making sure that the corporation does meet all the criteria in order to qualify. The tax savings is a consideration. For each lifetime capital gains exemption, it could save between $244,000 and $268,000 a person. But you have to consider the cost of the alternative minimum tax. So, like, if the parents are quite on in years and there's a possibility they if they're not in good health, that they could pass away, and you need to consider that, because there's alternative minimum tax that could be paid up front that may not be recoverable if they pass away. And then there's the requirement for that independent assessment of value, like a formal valuation of the company should be done. And just in conclusion, like, it's not a one size fits all type approach. Like, there's a lot of factors that need to be considered and a lot of complexities that need to be worked through in order to determine if Bill C-208 is a good option for each individual situation.
Jack, I'm just going to add one thing here, if I can.
Yep. Go ahead.
You know, something that we spend a lot of time with is monitoring status of farm corporations. And I mean, it's an unsafe assumption to assume that because you're actively involved in farming that your farm corporation qualifies as a farm corporation, because we find lately as farms are gaining maturity, they're gaining wealth. And with that comes more complicated assets that end up inside of the farm corporation. And you know, with sometimes you have to step back and look at the corporation to make sure that it still meets the test, and you may very well not meet the test. And a lot of work that we do and Jack's group does is in reorganizing companies to remove the assets that are putting them offside, so to speak, so that their farm still continues to qualify. Because if the farm fails to qualify, it loses out potentially on a lot of the specific sections of the Income Tax Act that are identified and drafted specifically for farms and only for farms. So, you know, as a farm corporation gets more mature, they have a tendency to get more complex, and with that, it could put you offside. But and 208 is really a great tool that, as Jack had mentioned before, where there is capital gain exemption that's not used yet, because it does create a pipeline and the ability for a family, whether it be the elder generation or the next generation, to actually remove funds from the corporation's cash profits on a tax-free basis. So we're finding it a very, very effective tool.
Yep,
Thanks,
for
Jack.
sure, Randy. Yep. Okay, so next I'm going to briefly go through some of the changes related to Section 55 of the Act, which used to basically consider siblings not related for purposes of splitting up a business. So under this scenario, you see that you have brother and sister and they own a farm corporation, 50-50, and it's gotten to a point in this situation where brother and sister would like to split up the farm and go their separate ways and do their own thing. So under the old rules, when splitting that up, basically there were situations where a capital gain could be triggered. So there's a concept for tax purposes called safe income. And essentially what that is safe income is like your tax paid retained earnings. So it's the amount of money that the company has made in the past that the company has paid tax on. So in this case, we say the company has a value of 2 million, but they've only got tax paid retained earnings of 200,000. And that can be because, you know, Farmco owns land that has gone way up in value, which is there's never been tax paid on that increase between the cost of farmland to the corporation versus the fair market value as of the time of this scenario. So within that, there can be, it was rather complicated to split up a family business like this. And under the old rules, so like each of the individuals here have shares worth $1 million. So to split it up, you would have brother incorporate a separate company. You would have assets transferring from Farmco over to Brother Co. And then you would have some transfers of shares and ultimately a redemption between the two companies to kind of break that tie. And that intercompany redemption, in this case, it would have triggered under the old rules $900,000 capital gain to Brother Co. And there would have been tax owing of around $237,000. So under the new rules, because siblings are considered related, that complication is removed, and it makes it a lot easier to split up a business. So some of the changes is they amended the legislation so that siblings are considered related for purposes of a split up of a family farm and fishing corporation. So it allows for a true divisive reorg under less restrictive divisive reorganization provisions, and previously complex division is now more simplified, and it can be done under this new legislation in a lot easier manner. And then just a note here that like when you are splitting up a farm corporation, there is considerations with land transfer tax is often, it cannot be avoided, and there may be situations where you're transferring land to a new corporation to split it up, and land transfer tax does apply, and there is a cost to consider there. So here's an example to kind of illustrate this. So under the old rules, so if you have two brothers who own a farm corporation, and they have 50 million in land and 4 million in cash, you had to go through a complex process to basically try to equalize each asset class. So like to get each individual with their separate corporation owning half the land each and half the cash each, whereas under the new legislation, It's going to make these splits a lot easier too, because now you can equalize with having unequal asset classes. So for instance, maybe brother one ends up with 27 million in land, brother two's got 23 million in land, but he's got the 4 million in cash. So it just makes things a lot easier on these types of divisions. So finally, the last thing I just wanted to briefly touch on is life insurance. So particularly in the context of a corporation. So whole life insurance, also known as permanent insurance, can be a very good tool to deal with equalization of assets on death. So maybe there's a situation where, you know, a farmer has some children not involved in the farm and they've got other children involved in the farm. Life insurance at the corporate level can be a good way to deal with payout of those non-active individuals through a more tax efficient manner. So the advantage of having a life insurance at the corporate level is it can be funded with dollars that have only had corporate tax paid on it. If it's held personally, you have to pay personal tax and then use the after personal tax money to pay for the life insurance policy. Whereas if it's held by a corporation, it's just the after tax dollars from paying corporate tax, which is a much lower rate than personal tax rates. The other advantage of holding a whole life policy in a corporation is that on death, the payout, the death benefit is can be flowed out tax free to the estate. And essentially that money is just received by the estate and can then be distributed to the beneficiaries of the estate. Life insurance can also be a good tool in funding estate tax liabilities for other assets that don't qualify as farm assets that are subject to tax on death. So if an individual has other assets, maybe they hold some rental properties personally, and those assets are not easily liquidated. Life insurance can be a good tool to have cash available to pay the tax, because those rental properties on death, they will be disposed of at fair market value and there's going to be tax owing. So life insurance can be a good tool to fund that tax liability there for the estate. So that concludes my presentation. So I'd just like to thank everyone for their time, and if there's any questions, I can field those now. We can field those now.
Thank you, Jack. We do have a couple of questions here. I'll just remind participants that if you want to post a question, you don't have to post it to everyone. You can direct it to the hosts and panelists if you don't want everyone to see your question. The first one, Jack, is what if mom, dad, son each own a third of the farm business? The farm corporation only owns the equipment and cash, and the land is owned by mom and dad and rented to the corporation. So what would be the best way to transfer the shares, or transfer or sell the shares to the son, and the best way to sell and transfer the farm land to the son?
Yeah, so that's a pretty particular situation. I can just make maybe some high level comments about that. In that situation, there may be some use to transferring the business under the Bill C-208 plan, because it will allow, so what could be done, so since the property is owned personally, like that property could be transferred at some point by mom and dad. Their interest could be transferred to the child, and there definitely be ability there to bump up the cost of that property and use the parents' lifetime exemptions on that property. But Bill C-208 planning is more advantageous in that if it can be used on the corporation, as long as the corporation owns equipment used in the farming operation, the shares of that corporation will still be a family farm and fishing corporation, to the extent that cash doesn't exceed 10% of the assets at the time of the transfer. That basically the corporation does have 90% of its assets are actually used in farming. And by using Bill C-208 in that transfer, it will create a debt owing from a new corporation owned by the children or child to the parents, and that will allow for future profits earned by that corporation to be paid out tax-free. So there are other considerations that need to really be looked at, like age of the parents, whether they're receiving OAS, like old age security, and the impact on that. Other considerations too is that alternative minimum tax on that transfer, because if depending on the income level of the parents and their income level going forward for the next 7 years, there may be a true cost there for alternative minimum tax. So yeah, it's definitely, there's a lot of considerations, but Bill C-208 could be a good plan in that situation.
In most go forward situations, though, on an existing farm, there's never typically not a problem in recovering all of your alternative minimum tax as long as you continue to earn income in the future.
Yeah.
Yeah.
Yeah, where it gets tricky is where parents are over 65 years of age, and there's impacts as far as OAS clawback to consider and everything too. But I did mention in my presentation as well that there is a capital gains reserve available too that can be used to kind of minimize the impact of some of that stuff. Yeah.
So the answer is there's lots of planning around that scenario.
Yeah, it's hard to get into specifics without having like a sit down and actually doing the plan. But yeah.
Thank you. I was going to add to that that where is the starting point? Is it figuring out the timing of when you want to do things? That yes, we definitely want to transfer, that we want a clear transfer, or whether mom and dad are going to stay in the business for a while longer, and we're going to do it over time. Do they need to have those things, those ideas in place before sitting down with you?
Well, I'll start. Maybe Jack can.
Yeah, go ahead.
But you know what's really important is if the farm business unit as a family is getting along, and a lot of times doing the transfer is best when everyone is getting along and they're happy with the efforts that each generation is contributing to the corporation or to the farm business itself. And usually when everyone is friendly and liking each other is the time to do it. But clearly, you know, one of the toughest decisions the elder generation has to kind of decide on is how much value is enough for me right now, and when is it okay to start turning value over to my next generation. And of course, you know, from a more let's say a business perspective, you know, involving the next generation as a shareholder is incredibly powerful in terms of a motivating factor in how they look at the farm. You know, so ownership means a lot to that next generation. And what we also see too is that, you know, a peer group of, you know, the ag community is a small farm community in Niagara, or almost everywhere you go. And if you know a certain generation feels like they should be a shareholder, and they look around in their peers and their friends and people they have coffee with and that already are, it's time to do it then, I suppose, you know, to kind of keep up, I guess, with the industry standard, I guess.
Yeah, I think to kind of add to some of Randy's comments, like I think one of the key points is that the parents are at a point where they want to bring children into ownership at some level. The way the legislation is now, it's pretty broad and it allows for a lot of flexible planning. So we have done some Bill C-208 planning where, you know, like the children are being brought in, but they're only owning 20% for now, the growth. Right, but the way the legislation is, we're able to work still in that to utilize the Bill C-208 planning. So I think that's kind of a key point, and that doesn't prevent them from transferring more in the future. And then often, yeah, you can use the intergenerational rollover rules for that to transfer the rest, and then there's no tax implications on that either. So I'd say the key point is where they're at a point where there's kind of definite individuals in their family that are ready to kind of take over some of the ownership, and that's always a discussion too that you work through constantly with your clients, like kind of seeing where they're at and where their plans are for the next number of years, and yeah, so like to kind of work through all that transition planning.
Thank you. I have another question here, and I suspect it may need a little more detail to really get at it. My wife and I are partners for the vineyard. The vineyard built a building, and the building is rented to the winery. The winery is a limited partnership, and we have 3 children to transfer the farm and winery to.
Yeah, so it gets a little tricky in situations where you've got the winery involved too, because the winery is not actually a farm asset or a farm business. So there's some more considerations that have to be looked at in that context. It sounds like, just kind of looking at the comments here, that the vineyard, it looks like it's owned personally maybe, and I'm not sure if that building was built personally on, like the winery building was built personally on the vineyard property, or if the building is held in the partnership by the winery. So he says yes, correct. So yeah, there are considerations there and stuff that has to be worked through, because sometimes farm properties can be thrown offside depending on the ownership structure of the winery operation. So like I'm just going to give another example. Like if you have a corporation that owns a vineyard and that corporation also owns the building on the property that is the winery, now you may not qualify for the farming exemption, because you have, if that winery building is more than 10% of the value of assets in the corporation, then it's no longer a farm corporation, because it needs to have 90% of its assets be used in farming, and winery is not a farming business. I guess some of the things here is there's still opportunity to use Bill C-208 planning, in that it's still what we call a qualified small business. So it's got a farm business and a winery. So as long as it's got active assets that are used in both businesses, Bill C-208 planning still could be done and make use of the $912,000 exemption instead of the $1 million exemption. And then there'd be other considerations there too, because if it is not a farming corp, then that can change the estate tax liability implications, because it can change the intergenerational rollover rules. Like if you have a corporation that's no longer a farm corporation, then there is a true tax liability on death, and in that case, you may want to look at, if children are coming into, kind of freezing the value of the parents in that business, and then allowing those parents to slowly chip away at their value, so that when they pass away, there's not a massive tax bill. So those are kind of some general comments. It's hard to, like I said, there's a lot of stuff to be worked through usually with planning under this legislation and in this intergenerational transferring of businesses. So.
Thank you, Jack. I think we're running towards the end of our time here. I'm wondering if people have additional questions, if they could possibly contact you or Randy for follow-up information, and if so, yep. Randy, could you perhaps post your telephone number in the chat?
I'll just go with my email address.
Perfect.
Okay. Whatever
works for you.
Yeah, I'll do that too. So.
I want to thank Grant Thornton and accountants Jack Kingma, Randy Momot, and Jamie Vongpit. Sorry, Jamie.
That's all right.
For giving us really what's a farm tax teaser. There's clearly a lot of things to be considered, and it requires advanced planning and help from professionals with experience in farm tax. A recording of this webinar will be available through our weekly update email. We'll send the link out there if you want to review it again. And keep an eye out for our 4th webinar in the series on legal considerations of farm transition planning. We're planning to hold the webinar this spring, but we don't have a date set just yet. So do we have the email addresses are there? I want to thank you for attending, and have a good day.
Thanks, everybody.
Thank you for having us.
Take care, everyone.
Take care. Bye-bye.